Hello everyone, and welcome back to the Velocity channel, where this is your bridge to financial freedom. So today I wanted to go ahead and solve another one of our members' problems. All right, they came to me with boatloads of loans, and now we're going to show them how to get out of all that debt in under 4 years. All right, not 9, not 10, not 15. Okay, but under 4 years, 3.7 years, according to our calculation. All right, and we're going to show you right here on this video. But before we get into that, please like, share, and subscribe so that people all around the world can know the power of leveraging what you have, all right, of Velocity Banking. All right, are you ready? Let's get into it. Now, they showed me their debts, and you could tell that they were very upset about it simply because they didn't know what to do with it. However, let's go ahead and show them and you what to do with debts like these. Now, your debts may be a little different than this one, but the principle that I'm going to go over is the exact same, and you can actually use that across the board with any debts that you have. For instance, $72,279.67. That could be on one debt, or like our member here, it can be on 5 debts. Okay, so they have 5 loans worth that amount. Okay, we have 2 lines of credit worth this amount, $1,438.19. And believe it or not, that's actually a bad thing. That's actually a bad thing when they don't have that line of credit, okay? When they don't have that much in lines of credit, what that's letting me know is that they've kind of drank the Kool-Aid, right? Actually, it was Flavor Aid. So they've drank the Flavor Aid, and they did not invest in lines of credit, which you can do, just so you know. That's right, we put up that link right now, yeah, because that's very important, that if you can get lines of credit, right, and you feel comfortable with it, okay, make sure that you are, because what that's going to do is it's going to rearrange your mindset and your thinking when it comes to Velocity Banking. You can do so many things with lines of credit. For instance, you can change those high interest loans out with that open-ended interest, right? Or that closed-end interest of the lines of credit. And so this is what I want you to do. I want you to picture these debts right here, okay? $1,438.19. Then we have 29.84%, and that loan is 9.13%. right? Monthly payment, $1,534.51. And then we have $50.15. And again, that's on the loans and the credit cards, respectfully. And again, folks, it's not about amortized or simple interest. Let me just get that clear, right? And let's clear that up. It's not about amortized or simple interest. It's about open end and closed end. Open end and closed end. We understand that loans have a lot to do with that front end loaded. Which loan, it's very popular, right? Which loan is most known for its front end loaded interest? That's the mortgage, that's right, okay? On this one, this individual does not have any mortgages. They just have the loans, and then some of it's mixed with finance loans, the personal loans, they have auto loans as well. So this one right here is just with their credit cards, all right, $1,438.19. Now, this individual was on track to pay it off in about 10 years. 10 years they were on track to pay it off. But with the income that they make, $5,480 per month, with the debt payments going out each month of $1,584.66, then the expenses of $3,700 each month, I can see why they thought they had no choice. We were able to get them down to 3.7 years just with using the cash flow that they had. That means not continuing to pay what they want you to pay, but transferring your finances in a wise and prudent manner in such a way that this number right here, the principal, okay, the principal of the loan and the credit card can come down drastically. Because when the principal comes down drastically, guess what else comes down drastically? That's right. That's right. The interest comes down drastically. Now let's talk about the interest rate. Look at that. 29.84, 9.13. Of course, lenders divide your payments, don't they? And of course, you're like, well, CJ, I know they divide my payments, each month. No. That's not what I mean. They divide your payments up into principal and interest amounts. So that minimum amount that you're paying, right, whether it's $50 or whether it's $500, that gets split up. Part of it goes to principal and part of it goes to interest. Sometimes you see that, more is going to principal, and that's good. But sometimes you get a villainous statement, right? And you find out that a lot of your payment is going to interest, more so than the principal. Now, I know this is the case on mortgages and other loans, but not every loan is created equally, so we cannot make a blanket statement like that and say that, well, every loan is going to be just like that. It's not. It's not. But I do want to caution you that the credit card companies and the loans, they are making money off of you on multiple ways. So it's not just this number. That's why I want to continue to reiterate, you have to stop looking at exclusively these numbers, because it's way, way more than that. Does that make sense? So, for instance, for the credit cards, they're going to be making money off of you not only on your monthly interest, but also on your statement versus payment due dates. Okay? Your statement date is different than your payment due date for a reason. Okay? Your payment is due. That means, man, I want to charge you as much interest until your payment is due. Okay? That's why they do it, so that they can get that interest, and they're counting on you not knowing that. However, when you place your income in a strategic way towards these loans, and you don't have to have a line of credit in order to do velocity banking, you've just got to make sure that your money is moved in the correct way at the correct time. For instance, if you have a statement date and a payment due date, what would you want to pay that credit card bill on? Let's say, would you want to pay it on the payment due date, or would you want to pay it on the statement date? These are just elementary things that you could do. And oh, you've got a bonus? Oh, you've got a raise? Now, I know that you earned that raise, right? You earned that bonus. But did you know that you could possibly make more if you paid one of these debts off? Absolutely. It's very true. So, Leslie, we actually have your everything customized just for you. The presentation is just for you. 3.7 years. And I may go ahead and release that on Monday. The name's going to be blurred out and all the other the details, but the numbers, they will be the same, okay? Because everybody has to deal with numbers, and you may have your own numbers, okay? We want to make sure that we solve your problems as well. We're going to be getting into detail with this person's numbers, right? And they're going to be out of all of this in 3.7 years instead of the slotted bank time of like 9.3 years, I think it was. Okay, so that's where we want you to look. Okay, we want you to look at your income, your debt pay, and your expenses. And if that cash flow is positive, then just realize that these numbers, they're going away very quickly, like in 3.7 years. Now, if you have more cash flow, of course, it'll go down even quicker. It all depends upon you. It all depends on how comfortable you are at paying down this debt at an accelerated rate. It all depends on you. Here is the link right there so that you can go ahead and take advantage of it. Let's go ahead and call me. I can run through your numbers. That's what we're here for. I want you to know God bless you, and give me the problems and we'll give you a solution. Take care and have a great night.